Stop whatever you are doing right now. Immediately. I don't care if you're in the middle of a meeting, mute it. I don't care if you're cooking dinner, turn off the stove. I don't care if you're on a date, tell her you'll call back. She's probably not that interested anyway. What I'm about to say matters more than anything you think you're doing right now. And if you own silver of any kind, physical coins, ETFs, futures contracts, mining stocks do not. And I mean do not. Check the price until you finish this video. Because what you're about to hear will completely change how you understand the silver market. And you need the full context before making a single decision. Are we clear? Good. Ladies and gentlemen, it's Sunday, January 18th, Launsilling Archelio, and at exactly 1147 a.m. Eastern Standard Time this morning, something happened that I genuinely never expected to witness in my lifetime. Something that shatters the unspoken agreement between the U.S. government and its citizens. Something that proves, both mathematically and officially, that the silver shortage is no longer a future event. It's here. It's happening now. And it's far worse than anyone predicted. At 11:46 a.m. this morning, the United States Mint, an agency of the U.S. Department of the Treasury, a direct arm of the federal government, issued a public statement. I'm going to quote it exactly, because you need to hear these words for yourself. Effective immediately, the United States Mint is temporarily suspending sales of American Silver Eagle coins in both bullion and proof versions. This suspension is due to unprecedented demand levels and current supply constraints affecting our ability to obtain sufficient silver planchets to meet production requirements. We are working with our suppliers to resolve this situation as quickly as possible. No resumption date can be provided at this time. We apologize for any inconvenience. Now let me translate that into plain English. The U.S. government has just admitted that it cannot supply silver coins to its own citizens. A government with limitless authority, vast financial resources, and deep connections to miners, refiners, and wholesale markets cannot secure enough silver to produce coins. Think about that for a moment. Consider the implications. The U.S. Mint has been producing American Silver Eagles continuously since 1986, 4 decades, through recessions, financial crises, wars, and pandemics. They have never fully stopped sales. In 2008, there were delays. In 2015, there were shortages, but they never shut down sales entirely. Not once. Until today, Sunday, January 18th. Launsilling Archelio. This is not a delay. This is not a backlog. This is a complete halt. And the reason is as simple as it is terrifying. They don't have the silver. Now let's look at the numbers. Because numbers don't lie. Politicians lie. The media lies. But math is absolute truth. In 2025, the U.S. Mint produced a total of 7 million American Silver Eagle coins. That includes both bullion and proof versions. In other words, 7 million ounces of silver were converted into coins and sold to the public over an entire year. On the surface, that sounds like a massive amount. But here's where the problem begins. In January 2026 alone, just the first 15 days, the U.S. Mint received orders for 3 million Silver Eagles. Let that sink in. 8.3 million coins in 2 weeks. That's half of last year's total production compressed into 15 days. At that pace, January by itself would generate roughly 17 million ounces of demand. And January isn't the peak, it's the starting line. February, March, April, the demand curve is accelerating. People are waking up. People are starting to understand that the $91 paper price is fiction. They're realizing that physical silver is vanishing. And they're rushing to buy from the one source they still believe they can trust, the U. With government, except there's one problem. The government doesn't have the silver. According to internal production figures, the U.S. Mint currently holds just 1 million silver planchets in inventory. Before moving on, a quick note for viewers who want to go beyond headlines. I've put together a short educational guide that breaks down the warning signals inside the physical silver market before major repricing events, things like inventory shifts, futures curve distortions, delivery stress, and policy changes. It's the same analytical framework I use myself, and it's available now via the link in the description. Planchets are simply blank silver discs that get stamped into coins. 1 planchet equals 1 silver eagle. So the mint has enough material to strike 1 million additional coins. But they're staring at an order backlog of 7 million. That's 7 million ounces of demand versus 2 1 million ounces of supply. That's a ratio of 5. 50 set to 1 for every single coin they can produce. More than 5 people are waiting. That's not a delay. That's not a backlog. That's a hard shortage, a mathematical impossibility. And here's the part that really matters. Even if the mint had an endless supply of planchettes sitting in a warehouse, they still couldn't keep up. The U.S. Mint has a finite production capacity. Across all facilities, they can strike about 40 January 1 8th00 silver eagles per day. Run the presses nonstop. 7 days a week. No holidays. That's roughly 2 million coins per month. But January demand alone was 2 trimillion. They would need to operate at 7 times their maximum capacity. That's not a logistical problem. That's not a management issue. That's physics. And physics doesn't negotiate. So, the mint did the only thing left to do. They stopped accepting orders. They suspended sales. They effectively raised the white flag. Now let me explain what happened yesterday that makes today's suspension even more meaningful. Yesterday, Tuesday, January 14th, we watched the Shanghai silver premium surge to $13. At the same time, the COMEX spot price in New York was frozen at $91, while physical silver in Shanghai was trading at $104. That moment marked a clear split in the global silver market. 2 parallel realities emerged. Paper pricing in the West, physical pricing in the East, and the gap between those two worlds was growing wider by the hour. And here's the key point. The U.S. Mint's suspension didn't just confirm this divide, it proved that the West has already lost. Why? Because the U.S. Mint is the ultimate supplier of retail physical silver in the United States. It's the backstop. It's the pressure release valve for the entire market. When private dealers run out of inventory, when premiums spike, when supply tightens, Americans have always been able to turn to the mint and buy silver eagles at a reasonable premium over spot. That's the unspoken agreement. The government supplies coins to citizens who want to protect their savings. But today, that agreement was broken. The government raised the white flag. It admitted that it can no longer meet its obligation. And once the official source of physical silver stops selling, the private market doesn't just react, it explodes. Within 2 hours of the mint's announcement, I checked pricing across major bullion dealers. Here's what I found. APMEX listed silver eagles at $142, accompanied by a warning extremely limited quantity. Expect delays. That's $91 spot, plus a $51 premium, a 56% markup. JM Bullion was completely out of stock. With a simple message, notify me when available. SD Bullion showed eagles at $145 for immediate delivery, $139 for back orders shipping in March. Provident Metals was sold out entirely. Money Metals listed eagles at $143, with a strict limit of 5 coins per customer. These aren't fringe dealers. These are the largest, most trusted names in the industry. And across the board, they were either completely out of inventory or charging $50 to $54 premiums over spot. $54. That's a 59% premium. When the mint was operating normally, silver eagle premiums were typically $4 to $6, maybe $8 to $10 during periods of strong demand. But 54 isn't a premium. It's a different pricing regime altogether. What you're seeing is the physical silver market trading at $142, while the paper market pretends the price is still $91. And here's the most important insight of all. Even at $142, eagles are still sold out. Even with a nearly 60% premium, buyers are lining up. Dealers cannot source enough inventory, even at that price. So what does that tell us? It tells us that the true clearing price, the price where supply finally meets demand, is higher than $142. Maybe it's $160. Maybe it's $180. Maybe it's $200. We don't know yet, because there isn't enough metal available to find out. But one thing is absolutely clear. The real price of silver is not $91. The real price is already above $142, and it's likely much higher. Now, let me explain why the arbitrage is finished, why dealers can't simply buy silver at a $91 spot price, turn it into silver eagles, and sell them at $142. This is the question everyone keeps asking. If eagles are trading at $142 and spot is $91, why wouldn't dealers just step in and capture that $51 spread? The answer comes down to 3 hard constraints. First, they can't get the planchets. Silver planchets used for eagles are produced by only a small number of specialized suppliers. These firms take raw silver, refine it to 99999 purity, cast it into precisely sized blanks, and ship those blanks to the mint. That production process has a hard ceiling. And right now, those suppliers are fully booked through March. They have more orders than they can possibly fulfill. Why is that happening? Because the raw silver they rely on, the 999 bars, has become increasingly difficult to obtain. Refineries are overwhelmed. When I contacted Johnson Matthey, one of the largest silver refiners in the world, they quoted an 8-week lead time for delivery of 1 January 1800 ounce bars. 8 weeks. In a normal market, that turnaround is 2 to 5 days. The entire pipeline from mining to refining to fabrication is jammed. Second, even if dealers somehow had access to planchets, they still couldn't turn them into eagles. Only the U.S. Mint is legally authorized to produce American silver eagles. No private entity can do it. That means dealers cannot spin up their own eagle production lines. They are completely dependent on the mint, and the mint has shut the door. Yes, dealers can and do produce generic rounds and bars, but those products don't attract the same demand. Silver eagles are government issued, government guaranteed, and universally recognized. They are the benchmark for silver coins, no pun intended. Generics are acceptable, but they don't command the same trust or the same premium. Demand is specifically concentrated in eagles, and eagles can only come from one place. That source has now gone dry. Third, the cost of acquiring silver at any level, even for generic products, is far above the $91 spot price. Dealers do not buy metal directly off COMEX at spot. They purchase from wholesalers, refiners, and other dealers. And those wholesale markets are already pricing silver well above paper levels. When I spoke with a wholesaler today, he quoted $117 for 1 January 1800 ounce bars. That's 26 over COMEX spot. Why? Because the wholesale market understands that the COMEX price is a fiction. They see the shortage. They aren't going to sell silver for $91 when Shanghai is paying $104 and India is paying $132. So the arbitrage collapses. Dealers can't source metal cheaply. They can't fabricate eagles. And they can't satisfy demand even at $142. The system isn't strained, it's broken. And now let me tell you what this reveals about the banks. The major institutions, J.P. Morgan, HSBC, Scotiabank. The players who have been structurally short silver for years are in serious trouble. And the U.S. Mint suspension just made their position dramatically worse. Here's why. For years, the banks have been shorting silver under one critical assumption that physical supply would always be there. They believed that if their short positions were ever pressured, they could simply step into the spot market, buy physical silver at a modest premium, and deliver. They assumed the mint would keep producing coins. They assumed the supply chain would continue to function. They were wrong, because today, the official source of physical silver for the United States government has publicly admitted it cannot obtain enough metal. If the U.S. government, with all of its leverage, purchasing power, and institutional reach cannot source silver, then how exactly are private banks supposed to do it? Take J.P. Morgan as an example. Analysts estimate that the bank is short roughly 50 million ounces of silver. I'm using rounded figures here. The true number could be somewhat higher or lower, but it's widely believed to be in that range. At a $91 spot price, that represents a notional short position of $4. 55 billion. On paper, the risk model looks simple. If the position needs to be covered, just buy 50 million ounces in the spot market. But that assumption collapses the moment you ask a basic question: where would those 50 million ounces actually come from? The COMEX registered inventory currently sits around 23 million ounces. That's less than half of what would be required. So the rest would need to be sourced elsewhere from refineries, from mining companies, or from overseas markets. But refineries are quoting lead times of 8 weeks. Mining companies have already sold forward most of their production for the next year. And overseas suppliers, particularly Shanghai, are not exporting silver due to government restrictions. So where does J.P. Morgan find 50 million ounces? The answer is simple. They don't. The metal does not exist in accessible form. And even if it did, what price would they have to pay? Certainly not $91. The wholesale market is already trading near $117. Shanghai is around $104. India is paying $132. Retail silver eagles are selling at $142. If a player the size of J.P. Morgan attempted to buy 50 million ounces, the price wouldn't inch higher, it would explode. We're talking $150. $170 or more. That implies a loss of $70 to $80 per ounce, just to cover the position. 50 million ounces multiplied by an $80 loss equals $4 billion. That's a $4 billion hit for a single bank on a single commodity. Spread that across multiple banks with similar positions, and you're quickly looking at tens of billions in potential losses. Yes, banks of that size can absorb losses in the billions if they absolutely must. But here's the key point. They don't want to, and they will fight to avoid it. They'll attempt to suppress prices. They'll try to engineer sell-offs. They'll raise margin requirements. They'll push negative narratives through financial media. But the U.S. mint suspension just made that job exponentially harder, because the narrative has fundamentally changed. The story is no longer that silver is too expensive. That argument can be sold. Expensive assets can be shorted. The story now is that silver is unavailable, and you cannot short something that doesn't exist. When the U.S. mint itself cannot obtain silver. Every viewer watching financial news understands the implication. Instantly, silver is scarce. That realization represents a psychological shift, one the banks cannot talk their way out of. So the banks are trapped. They're short. They can't cover. Prices are rising. Physical supply is vanishing. And now the U.S. government has officially confirmed the shortage. That's checkmate. Now look at what's happening across other markets. Because silver is not moving in isolation. What we're witnessing is a broad breakdown in confidence toward paper assets as a whole. Gold has just printed a new all-time high at $2, $644 per ounce, up more than 40% from where it began in early 2025. Gold is effectively sending a warning signal to the world that something is fundamentally wrong with fiat currency. At the same time, U.S. Treasury yields are surging. The 10-year yield hit 68% today, up sharply from 8% just 6 weeks ago. That move tells you everything you need to know. Rising yields mean falling bond prices. Investors are dumping U.S. government debt. They're selling treasuries. And the reason is simple. Trust is eroding. Confidence in the dollar is fading. Confidence in the government's ability to manage its finances is fading. So capital is flowing out of paper claims and into tangible assets, gold, silver, real estate, anything that cannot be created out of thin air. Equities are feeling the pressure as well. The stock market has turned volatile, with the S&P down roughly 12% from its November highs. Why? Because corporate profits are being squeezed by rising commodity costs. Companies that rely on silver, copper, lithium, and rare earth metals are seeing their input expenses explode. Margins are shrinking. Earnings are missing expectations. And the Federal Reserve is boxed in. They can't raise interest rates aggressively without risking a severe economic downturn. But they can't cut rates either, because that would pour fuel on inflation and further undermine the currency. There is no clean exit. They're in checkmate. And the smart money understands it. That's why gold is at $2. That's why silver trades at $104 in Shanghai, while retail prices in the U.S. sit near $142. That's why treasury yields continue to rise. This is the market casting a vote of no confidence. It's the collective signal that paper promises are no longer trusted. Investors want real assets. And silver, arguably the most undervalued hard asset when measured against its industrial demand, is right at the center of this storm. Now let's talk about India. Because India is a critical part of this picture. India is the largest consumer of physical silver in the world. Demand, there isn't speculative, it's cultural, religious, industrial, and generational. Indians buy silver the way Americans buy smartphones. It's deeply ingrained right now. The Indian silver market is in full-blown turmoil. Local prices have surged to 295 January 18th 00 rupees per kilogram, which translates to roughly $134 per ounce at current exchange rates. $134. While COMEX prints $91, India is paying $134, a $43 premium, or roughly 47%. And it's not just about pricing. Supply is gone. Major bullion dealers in Mumbai, Delhi, and Bangalore are listing products as out of stock. Refineries are refusing new orders until March. Buyers are lining up for hours just to secure limited allocations. This isn't normal demand. This is panic buying. This is hoarding behavior. Indians understand what currency collapse looks like. They've lived through it. They've watched empires rise and fall. They've seen fiat money lose its value. So when they recognize that silver is becoming scarce, they don't hesitate, they act. They sell gold jewelry to acquire silver. They pull savings to buy silver. They borrow from family members to buy silver. They do whatever is necessary to get physical metal into their hands. And they're willing to pay $134 per ounce, not because they're uninformed, not because they don't see the COMEX price at $91. but because they know that price isn't real. They understand that the physical price is the only price that matters, and they would rather pay $134 for real silver than save $43 and be left with paper promises. This isn't limited to India. It's happening in China. It's happening across the Middle East. It's happening everywhere except in the West. The West is still asleep. The West still believes in the system. The West still assumes that $91 is the real price. But the East is fully awake. And while the West clings to paper claims, the East is taking delivery of the metal. And when the West finally realizes what's happening, there will be nothing left to buy. So, what does this mean for you? What should you be doing right now? Let me be absolutely clear. If you already own physical silver coins, bars, or rounds, whether they're in a home safe, a safety deposit box, or allocated storage, do not sell. Don't even consider it. You are holding the winning ticket. The price you see flashing on a screen, $91 spot, is fiction. It's a fabricated number created by paper traders moving contracts they have no intention or ability to deliver. The real price is the price people are actually paying. And right now, that's $104 in Shanghai, $132 in India, and $142 for silver eagles in the United States. And it's moving higher. The U.S. Mint has stopped selling. Industrial consumers like Tesla and Apple are struggling to secure supply. Banks are trapped in massive short positions with no realistic exit. The runway to $150. $170. Even $200 is now wide open. So if you hold physical silver, hold it tightly, don't let go. This is exactly where you want to be positioned. If instead you own silver ETFs like SLV or PSLV, you need to seriously reassess your exposure. SLV is custodied by JP Morgan. Ask yourself this. Do you trust JP Morgan to have the metal when JP Morgan itself is one of the largest short sellers in the silver market? Do you trust them to deliver if the system is stressed? Or do you expect a force majeure event and a cash settlement at $91 while physical silver trades at $142 or more? I know where I stand. PSLV is a stronger structure. It's stored at the Royal Canadian Mint and offers better redemption terms. But even PSLV is not immune to political risk. In a severe crisis, the Canadian government could choose to nationalize strategic metal reserves, leaving holders with a cash settlement in Canadian dollars. Is that really what you want? The only option without counterparty risk, without institutional risk, without government risk, is physical metal that you control. Just you and the silver. The only option that is truly safe is physical metal that you personally control. No counterparty risk. No government risk. Just you and the silver. If you're holding silver futures or options on the COMEX, you are taking an extreme risk. The U.S. Mint has just confirmed that physical silver is scarce. So ask yourself this, do you honestly believe the COMEX has enough metal to honor your contracts? Do you really think they're going to hand over 5 January 18th00 ounces of physical silver when the U.S. government itself can't secure enough metal to strike coins? It's time to wake up. The most likely outcome is simple. The COMEX will invoke force majeure and settle contracts in cash. You'll receive $91 per ounce while physical silver trades at $142 or higher. That's a $51 loss per ounce because you trusted paper claims instead of real metal. Don't make that mistake. Exit your futures positions. Take the cash while you still can. Convert it into physical silver before the opportunity disappears. If you don't own any silver yet and you're considering buying, here's the uncomfortable truth. You may already be late. The U.S. Mint has halted sales. Private dealers are either completely out of stock or charging 50% to 60% premiums with extended delivery delays. The window is closing fast. But if you're going to act, this is how you do it. Do not wait for prices to pull back. They won't. Prices are rising. Premiums are expanding. Availability is shrinking. Every day you hesitate. Conditions get worse. Call a dealer today, any reputable dealer. Ask one simple question. What do you have in stock right now? Ready to ship, not back-ordered. Not promised. In stock. If silver eagles are available, buy them even at $142. If eagles aren't available, buy generic rounds or bars, 1-ounce rounds, 10-ounce bars, 100-ounce bars, whatever is available. The shape doesn't matter. The metal does. Accumulate ounces. Accept the premium. Tolerate the shipping delay. Because when silver is trading at $170 and there's no physical supply at any price, you'll wish you had paid today's prices without hesitation. This is not financial advice. I'm not a financial professional. I'm simply someone analyzing the data and describing what it shows. And what the data shows is a market under stress. a system starting to fracture, a government that has admitted it cannot supply silver to its citizens, and a physical price that is surging while the paper price pretends nothing is wrong. You have to decide which reality you believe in. The paper version of reality, where silver is $91 and everything is fine, or the physical reality, where silver is $142 and the system is clearly losing control. That decision is yours, but it has consequences. Now let's talk about what comes next, because everyone wants a timeline. When does this resolve? Where does the price ultimately go? I don't have a crystal ball. I can't give you an exact date or an exact number, but I can outline the pattern based on history, on fundamentals, and on the data unfolding right now. In the short term, over the next few days or weeks, expect extreme volatility. The paper market is going to push back hard. Banks may unload large volumes of paper contracts in an attempt to trigger a sell-off. The CME could raise margin requirements again. The media may roll out negative headlines about silver, all designed to shake weak hands one last time. The COMEX price could even dip to $85 or $80. But the physical market will not follow that move. Shanghai will remain above $100. India will stay north of $120. Retail silver eagles will continue trading above $140. Premiums will remain elevated because the shortage is real and unresolved, and then something will snap. Maybe a major industrial consumer publicly admits they can't source silver. Maybe the COMEX declares force majeure during a delivery month. Maybe another government mint halts sales. Maybe China announces additional export controls. Whatever it is, that event will serve as the catalyst. When that catalyst hits, the paper price will reprice violently. We're talking about a sudden gap higher, a $20 to $30 move in a single trading session. Silver could jump from $90 straight to $120 or $130 overnight as the market finally accepts. What's been obvious all along, the paper price was fiction. The real price was already being set by Shanghai and India. And once the paper market breaks, there is no upper boundary. Price discovery shifts entirely to the physical side. Silver will trade at whatever level real buyers are willing to pay. Some analysts are calling for $375 by 2028. I think that estimate is conservative. If the system fractures hard, $375 by late 2026 is entirely plausible. Why? Because industrial buyers who need silver to keep factories running will pay whatever is required. Because hundreds of millions of people in India and China trying to protect their savings will pay whatever is required. Because governments scrambling to secure strategic resources will pay whatever is required. That whatever could mean $400. Wu bai mei yuan. Even $600 per ounce? It sounds absurd until you remember that $142 sounded absurd 6 months ago. So did 104 in Shanghai. The impossible keeps becoming reality because the fundamentals are overwhelming. The shortage is real. Demand is real. Supply is not returning. And the U.S. Mint suspension has now confirmed that fact officially. So here is the final message. The U.S. Mint halting sales is not a minor inconvenience. It is not a routine supply chain disruption. It is a smoking gun. It is mathematical proof that the silver shortage has arrived. It is formal confirmation from the U.S. government that it cannot supply silver to its own citizens, and it is your last clear warning to move out of paper claims and into physical metal while that option still exists. Do not wait for CNBC to explain it to you. Do not wait for permission from a financial advisor. Do not wait for a government emergency announcement. By that point, it will already be over. Dealers will have no inventory. Premiums will hit 100%. Prices will push past $200 and keep climbing. And the biggest opportunity of your lifetime will be gone. As of Sunday, January 18th. 2026. The situation is clear. The U has People's Foundational. Mint has stopped selling silver eagles. Shanghai is pricing silver at $104. India is paying $132. Retail eagles in the United States are trading around $142. The banks are cornered. The system is cracking. And the physical silver market is effectively drained. If you're holding paper claims, get out now and move into physical metal. If you already own physical silver, do not sell. Not under any circumstances. The true price of silver is not $91. It's not even $142. The real price is whatever people are willing to pay when they are desperate, and desperation is approaching fast. The upside target is $375. The timeline is accelerating. The shortage is no longer theoretical. It's official. The mint is out. The structure is broken. And you have to choose right now where you stand. Get out of paper. Get into physical. Act decisively. Do it now.